Now, let's look at what Mr. Idris will handle. If I've done 1, I've done 2, I've done 3. Mr. Idris is going to handle 4 and 11. I will handle IPSAS 13 and IPSAS 17 and 33. Now, let's look at IPSAS 13. What is it all about before we move to the next stage? We talked about the cash flow. I mean, we don't have visual, and I gave you the format relating to that cash flow for both direct and indirect methods. Now, we need to work on the calculation, which I'm going to do today. But let me quickly run through IPSAS 13 and IPSAS 17 for us to be on the same page. It will not be new to as I'm putting. And construction, that is contract account. I don't want to infringe, and it's going to handle IPSAS 12. And if it doesn't handle it, I will come back and do it. But how we handle IPSAS 13? Do you understand? Now, what is IPSAS 13? Can you see IPSAS 13? Can you see IPSAS 13? Hello? Can we all see IPSAS 13?
Yes, sir.
Yeah. What is it all about? It is an arrangement. It is an agreement between two parties where one party owns a property and the other party is meant to use that particular property based on an agreed amount or the agreed lease agreement between the two of them. Yeah. We have different things that has to do with it, which can be in kind of what contingency rent. It could be in terms of what finance lease. It could be a kind of commitment of the lease, depending on what and what that are involved. Simply means basically we have two types of lease agreement. We have what we call the finance lease, and we have what we call the operating lease. The operating lease is an agreement between the two parties, where the one is a tenant and the other is what is a landlord. And on that particular ground, the operating lease, the risk and the benefit, the cost of maintenance is attributable to the lessor. Why, when it comes to finance lease, it's lessee that handle anything relating to the what? To the risk and anything relating to the finance, maintenance. And in terms of the benefit, the benefits also accrue to what? To lessee. But let's read it from the book. Let's see what the book is talking about when it comes to this contract. This aim of the standard is formulated to prescribe for the lease and lessor the appropriate accounting policy and disclose to apply in relation to the finance and operating lease, telling us that there are two types of lease, finance lease and operating lease. What are the definitions we are meant to look at now? The following are the definition provided by the standard. The commencement of the lease term, the date from which the lease the date from which the lease is being what? Now, what are the things we also need to have idea of under this part? The terms simply means what are the arrangements between the lessee and lessor. This is the date from which the lease is entitled to exercise the right. The lease, that is the lessee, is wish to exercise the right to use the lease property. That is, we are looking at the terms and agreement between the two parties in terms of lessee and lessor. When the lessor is giving out the property to lessee, what are the time involved? The initial recognition of the lease, what are the payment terms that are involved? That is the commencement lease term. We also have what we call the contingency rent. This is the portion of the lease payment that is not fixed in terms, fixed in amount, but based on the future amount of a factor that changes. That is, this has what we call fluctuating. That's why they call it what? Contingent lease. It is fluctuating based on situation. It is it has no fixed rate of what? Of an amount. E.g., percentage of the future sales, the amount of the future use of the property, the future price. We also look at what the future market rate of the interest. Now, we also have what we call the finance lease. This is a lease that transfers the substantial of the risk and the reward incidental to the owner of the property. Title may not or may not eventually being transferred depending on the arrangement. But all this, they are just a tantamount of what we call idea you are meant to gather. But what is it all about? That is where we are going now. Initial direct cost, all this implication of the fees in terms of the lease payment and the unguaranteed residual value, the fair value of the lease asset, the initial direction, all this one, they are just a tantamount of what you have idea of. But what are the things you also need to know when it comes to this, which is what I need to discuss. Because all this, if you are just reading, you might not get it clearly. Let's quickly run through all this. It won't be as if we are just rushing ourselves. Because now, when we look at it from what we call gross investment in the lease, gross investment in the lease, that is the amount involved in getting that particular property. This is the aggregate of the minimum lease payment receivable by the lessor under the finance lease. Any unguaranteed residual accrued to the lessor. Guaranteed residual value is the one for a lease that part of the residual that is guaranteed by the lessee or by the party relating to the lease, the amount of the guarantee being the maximum amount that could be in any event becoming possible. The next one, for a lessee, the payment of the residual that is guaranteed by the lessee or by the third party unrelated to the lessor that is financially capable of discharging all the obligation under the guarantee. What we are referring to here is that the amount that are involved in the lease contract, that is the lease payment, how much is the minimum amount to be paid, and what are the other related residual amounts that are not part of the agreement but that are also involved. Who are responsible for that? The inception of lease is the earlier of the date of the lease agreement and the date of commencement of commitment by the parties to the principal provision of the lease. As at this date, the lease is classified either operating or finance lease. In the case of finance lease, the amount to be recognized at the commencement of the lease is determined as the lease payment at the beginning. Initial direction costs are the incremental costs that are directly attributable to the negotiation and the arrangement, the lease exception for the such costs incurred this and that. All these are what we have looked into from the beginning to the end. But in terms of the costs that we are meant to be involved, let's go to the mean. What are the things you also need to have idea of? Now, we've been able to know that lease is an arrangement between two parties, the lessee and lessor, in which lessee is the person that is meant to make use of the property, while lessor is the owner of the property that is meant to be giving out the property to someone to be using based on an arrangement, based on an agreement, the terms and conditions that are involved in the lease contract. As a result, there are two types of lease. What are the two classes of lease we have? We have what we call the finance lease, and there's what we call the operating lease. When we talk of the finance lease, the lease under this, all the risk, the reward are attributable to the what? To the lessee. Now, On a normal day, the payments you are giving out will be given to lessor. But in terms of the use of the property, in terms of the benefit that the enjoyment of that property is attributable to the person using that particular property, which is what? The lessee. Now, a lease is classified as a finance lease if it is transferred substantially all the risk, the reward incidental to the ownership. A lease is classified as operating lease if it does not transfer such all the risk and the reward incidental to the owner. According to the standard, the further characteristics of finance lease, of which the presence of the combination of will normally lead to the lease being classified as finance lease. Now, we need to have an idea of what are the characteristics of finance lease and what the operating lease. The lease transfer ownership of assets to the lessee by the end of the lease term, lease agreement. Lessor has an opinion of purchasing the property as at a price that is expected to be sufficient, lower than the fair value. Now, in a summary form, when it comes to finance lease, possibility of transferring the property, the ownership of the property to lessee at the end of the contract is very, very certain or high. The risk of the asset is meant to be what? Attributable to lessee. Apart from that, the maintenance cost is also attributable to lessee when it comes to finance lease. But when it comes to operating lease, such will not happen. Aside that, under the finance lease, it is also clear that the cost, listen please, the lease payment is meant to be capitalized. The capitalized lease payment, that is the amount that is being paid as what? Lease payment under finance lease is meant to be capitalized, because in the future, there is possibility of transferring the ownership of that particular property from the lessor to lessee. Now, under this, the principal amount will be different from the total amount to be paid. Principal amount, that is, if you are meant to purchase that particular property purchase it outrightly, what you are going to pay, which is the principal amount, will be different from the lease payment, total lease payment. At the end of the day, the amount you are going to have will also include what? The interest. Which means that interest will also be capitalized. You capitalize the principal and you capitalize what? The interest under this particular finance lease. But such is not possible under operating lease. Let's see other things we also need to look at. We said the lease term is for the major part of the economic life of the asset, even if its title is not transferred. At the inception of the lease, the present value of the minimum lease payment amounted at least substantially all the fair value. All this one, they are just English, but I've summarized it already. But just let us have an idea of what it is all about. The lease assets are of such specialized nature that only the lease can be used. The lessee can use them without major modification. All these are the characteristics relating to that. The gain and the loss of the fluctuating in the fair value of the residual accrued to the lessee. That is, any incremental of that particular property is attributable to lessee. Now, let me also declare between the two of them. Now, when it comes to operating lease, it is an arrangement between the landlord and tenant. The lease payment under the operating lease is meant to be expense. That's one. Two, the risk of the asset is attributable to lessor. The maintenance cost is attributable to lessor. The benefit of that particular property is attributable to lessor. Do you understand? And it is also clear under the operating lease that the possibility of transferring of the property at the end of the lease agreement is not certain. It's not possible at all under the operating lease. Landlord will not transfer his property to the tenant, even though the tenant is now going out, except there is an agreement that I want to buy your property in the nearest future, which you are going to make payment that is going to be lesser than the fair value. All these are the classes. What are the information to be disclosed when it comes to what? The lease in the financial statement. Now, you also have the idea of what you are meant to disclose. At the commencement of the lease, now, you need to have idea that the property that we call finance lease will be recognized as assets under the what? Statement of financial what? Position. And the payment you are making will be referred as what? Liability until you make the final payment. That is when the ownership will be transferred. Now that's what they are now saying, that the assets and liability shall be recognized as the amount equal to the fair value of the leased property. Or if, however, the present value of the minimum lease payment each determined at the inception of the lease. If this is practicable to determine, if not, the lessee incremental borrowing shall be used. That is, the borrowing means the amount you have borrowed will be recognized. Now, looking at it from the lessee, what are the things to be disclosed in the finance lease under lessee's account? Are you with me? You are meant to look at it from the what? The asset value. You look at the carrying amount, reconciliation of the minimum lease payment that you are meant to be recognized in your book. In addition, it cannot be less than 1 year that you are meant to make your payment. Later than 5 years, when we look at the arrangement of the lease, possibly 5 years agreement would be what? Specified, depending on the arrangement. Possibility of, in the nearest future, if there's going to be cancellation or non-cancellation, will also be determined. As I said, the total future minimum sublease payment expected to be received under the non-cancellation or sublease at the reporting date, when you sublease that particular property to another person. Now, all these are what you just need to know, but the calculation, we are going to look at it when we are solving what question. Another area which we also need to look at, there's another one they call lease back. This one normally happens in the bank. When bank buy an asset, somebody buy an asset, bank was using it, then they later buy it over and they lease it out. That is what we call lease back. Then if they paid you a sum of amount of money as an advance for operating lease, it's going to be taken as liability at your own end, as refers to as what we call deferred income. You take it as what? Deferred income. Deferred income. You can't recognize the total amount of money you have received under the operation as your total revenue. If it is going to last for 5-10 years and they pay you the total sum of money for the whole 10 years, the whole 10 years amount, the revenue cannot be recognized as your total revenue in that year. It's going to be a deferred income. You will be reporting on a yearly basis, what based on the amount to be recognized in your book as your lease payment, based on the arrangement between the two parties. Now, on this note, you can take your time to read them one after the other. And if you also look at it under the lessor, look at it. Lessor payment under the operating lease. Lessor shall present the assets subject to operating lease in the statement of financial position according to the nature of the asset. Whether it is an asset, you will know. The lease payment under an operating lease shall be recognized as an expenses, I've said it, on a straight line basis over the lease term unless another systematic basic representative, that is, there is a change in the process. But that one, under the finance lease, the payment will be capitalized, while under the what? Operating lease, the payment is going to be what? Expense. All these are what you need to take note. Is that clear? And operating finance lease is subject to what? Depreciation. We also need to take note of that based on the lease agreement or the policy of the organization. And other things that you also need to disclose, the information you also need to disclose, you are meant to disclose the contingency rents involved, you are meant to describe the lessor, the material lease arrangement, that is the arrangement between the two parties on that particular what lease. And in your financial statement, you are meant to have what? Recognition of what? The lease you are receiving in terms of the finance lease revenue. These are the things you also need to have idea of when it comes to what? Lease agreement. Under the, let me list it again, likely characteristics that can be seen under each. Under the operating lease, the benefit of that particular property, benefit of the property is attributable to lessor. The maintenance cost of that particular property is attributable to lessor. The lease payment under operating lease is meant to be expense. Rent received is going to be recognized on a periodic basis based on the lease agreement as what? Rent received on a contingency basis. And at the same time, the ownership will not be what? Transferred at the end of the agreement of the operating lease. But when it comes to finance lease, the benefits of that particular property is attributable to lessee. Transfer of ownership is possible at the end of the lease agreement under the finance lease. Aside that, the risk of the asset is attributable to lessee. The lease payment is meant to be capitalized. Maintenance of the property is attributable to lessee. Unpaid lease will be referred to as what? Receivable in the book of what? Lessor. These are the things you need to have idea of. There is a principal amount of the lease agreement. There is a terms of agreement under the lease. 5 years, 10 years for the payment to be done, depending on the arrangement between the parties. But the standard specifies 5 years. Aside that, there is a lease payment which is going to be on equal basis. But that is not possible under the operating lease. Then we also have what? IPSAS 13. Let me look into that because those are the things that we need before we now look into all the questions. What is IPSAS 33 is all about? IPSAS 33, what is it all about? You need to have idea. IPSAS 33 is known as what? Transition basis. Transition basis. What are the transition? Transition in the IPSAS simply means when an entity is changing from cash basis to accrual basis or adopting the what? The use of IPSAS for the first time. What are the procedures to be taken into consideration when you are looking into this? One, you need to look at it. What is the financial year of that particular organization? the accounting year of the organization. What accounting basis is being adopted in preparing the account for the initially, and what accounting basis is meant to be adopted presently. Aside that, they will also look at it.
What we can see
What are the adjustments to be taken into consideration in terms of the prior year adjustment, end of the year adjustment, correction of errors based on the accounting standard you are trying to imbibe into the system. Then preparation of journal for the opening of accounts. KG.
Yes, what we can see are the questions, not the IPSAS.
Hey, sorry.
Yes, okay.
Let me go to where that one is. But let me explain. I will forward it to you. What is it all about? You talk it what? It's all about transition. Exactly. Transition process. Are you with me? We are talking of the first time you are coming up with use of IPSAS, or the first time of changing from cash basis to accrual basis. That is what it's all about. And what you are meant to do, being the first time you are doing that. That is what we mean by IPSAS 33. Is that clear? Is it clear? Do you understand what I've explained there? But I don't know where I put it, but I thought I updated this particular one. But I will forward it to you. Immediately I check it, I will forward it to you. Don't worry. I will forward this one back to you the way I used to do. I will adjust it and forward it back to you. Now, what do we mean by transition process? Transition process is the process where an organization that is adopting cash basis before want to change over to accrual basis, or first time of adopting IPSAS. Then what are the things to be carried out, the factor to be considered? Factor to be considered includes the following. One, we talked about the accounting year, identification of accounting year of that particular organization or the entity. Number two, what type of basis is he using before? Identify the old basis and the new basis to be changed to. What are the adjustments? Number three, the necessary adjustment to be done in terms of correction of errors, in terms of prior year adjustments, asset recognition, and various accounting policy to be recognized, and all the necessary information to be disclosed in the financial statement. All these are meant to be carried out. And two, preparation of journal for the correction of errors and the adjustments. The last one, preparation of opening statement of affairs, which is for the first time after the necessary adjustment has been done, you are meant to prepare statement of financial position, which we call opening statement of affairs of the organization. All these are meant to be looked into when it comes to IPSAS 33, before the commencement of the use of the new accounting standard. That is what you need to have idea of when it comes to IPSAS 33. But I will do it and forward it to you. Another area that we also need to look at is IPSAS 17. IPSAS 17. What do you to know about IPSAS 17? Let me move down to the place. You can have the full idea of what I'm talking about. It will not be new to you. Can you see the new information I'm giving to you? IPSAS 17. Hello? Hello?
Hello, sir.
Yeah. Can you see IPSAS 17 now? I've done some adjustments here. That's why I'm coming up with this one. I will forward this one to you. IPSAS 17. Can you see it? Hello?
Yes, sir.
Now, what is it all about? It's all about what? Accounting treatment for PP, property, plant, and equipment, PPE. Accounting treatment, accounting recognition in terms of cost, in terms of depreciation, in terms of what? Revaluation, asset revaluation. Do you understand? And asset disposal. All these are what you need to know when it comes to what? IPSAS 17. How do we go from here? The standard is set up to prescribe the accounting treatment for property, plant, and equipment so that the users of financial statement can discern information about an entity's investment in property, plant, and equipment and changes in such investments. The principal issue in accounting for property and equipment are the recognition of assets, determination of the carrying amount, the depreciation charge, and the impairment loss to be recognized in the relation to them. Now, what are we referring to here? We are telling you that when it comes to what? Property, plant, and equipment, what you are concerned about, what that particular standard is relating to is accounting treatment for property, plant, and equipment in terms of the cost of the asset, cost recognition, in terms of the depreciation, in terms of the carrying amount, in terms of asset impairment, in terms of asset revaluation. What are the terms and terminologies under this particular part? We talk of what? Carrying amount. What do we mean by carrying amount? That is the amount after you have deducted your depreciation or the impairment. That is the carrying amount. When you deduct the depreciation from the cost of the asset, that is referred to as what? As carrying amount. When it comes to what? Classification, classes of property, plant, and equipment, there are ways in which we can classify assets and non-current assets in terms of what? The usage. Now, looking at it means a group of accounts of assets or similar nature or function, depending on what the classes you have created in your organization is all about in the financial report. Then the next one is what? Cost of the assets. The initial cost of that asset, or looking at it from the fair value that can be used when you are acquiring the asset or you have constructed what? The asset. Then we also look at it from the depreciation point. That is allocation of depreciation, the amount you are meant to spread over the use of the what? Of the asset. That is what the depreciation. Aside that, we talk of the entity specific what? Value in terms of the present value of the asset. We talk of the what? Exchange transaction when you are changing your property for another property. What are the accounting treatments we are also meant to look into? The impairment loss and impairment gain. All these are what we are meant to recognize. Non-exchange what? Transaction. Those ones we also meant to look into the impairment loss and impairment gain. All these are the terminologies that we are also meant to look into. And part of the asset that cannot be what? Depreciable. The part of the asset that cannot be depreciated is residual value of the asset. Now, we are now here. Recognition. Cost. The cost of items of property, plant, and equipment shall be recognized as assets if any of one. It is public that the future economic benefit or services potential associated with the asset will be what? Inflow to the entity. The cost or the fair value can be measured reliably. All these are referred to what? Cost of the asset in terms of that. How do we measure that? Measurement. An item of property, plant, and equipment that qualify for recognition as an asset can be measured as it is in terms of cost. Where an asset is acquired through a non-exchange transaction, it shall be measured at fair value. We use fair value to do that. What are the things to be disclosed when it comes to what? Assets, what? Property, plant, and equipment. 1A, measurement based on what? Used for determining the what? Gross carrying amount. That is, look at the cost. They are meant to look at the start what? To tell us what the cost you have purchased the asset, the carrying amount of the asset, the depreciation method, the useful life of the asset, the rate of depreciation, the gross amount, asset disposal, addition of the asset. All these are meant to be disclosed. Acquisition through the what? Entity combination in terms of what? Increment and in terms of increase and decrease in result from valuation. We are talking of what? Asset valuation. Impairment loss, recognition in terms of surplus and deficit. How do we treat that? That is IPSAS 31, IPSAS 21. Now, looking at it from what? Impairment, asset what? Impairment of asset. We compare the what? We compare the surplus or the deficit. When it is gain, it is what? Surplus. When it is loss, it is what? Expense. You expense it. That surplus will be added, will be debited to your what? Asset account. You debit your asset account with surplus and credit your income what? Statement. If it is now deficit, you debit your what? Your income statement and credit your what? Your asset account. That is the accounting treatment for that. We are going to see that in future. Now, looking at it, cost of non-what? Cost of non-current assets. 1, we are meant to consider what we call purchase price of the asset, transportation cost, installation cost, cost incurred in the process of training the staff for the use of the asset, administrative cost incurred in the cost of ordering the asset. All these are costs to be recognized. We also talk of what? Depreciation method. We have what we call straight line method. Under the straight line method, depreciation is calculated as cost minus residual value over the useful life of the asset. When it comes to what? The reducing balance method, that's the second method. We are meant to consider the assets, the cost of the assets, the net book value, and the depreciation rate. How do we calculate the depreciation rate? Look at it. We look at it as what? Depreciation rate is equals to 1 minus nth root of residual value divided by cost. What is n there? That is useful life of the asset. When we talk of RV, we talk of residual value. When we talk of cost, initial cost of the asset. When we talk of the weighted average method, we look at the cost of the asset less what? The residual value. When you less residual value from the cost, what you have is what we refer to as depreciable amount of the asset. Then how do we calculate this? How do we calculate what? Depreciation under this method. We are meant to weight the year of the asset. The weight of the asset is what? 15. When you have, we take it as an example, 5 years. When we had everything together, it's going to give us 15. 1 plus 2 plus 3 plus 4 plus 5 is giving us 15. The weight of the asset will now be in year 1, 5 over 15. In year 2, 4 over 15 times depreciable amount of the asset. That gives you the depreciation for the year. In the second year, 4 over 15 times the real part of the asset. 3 over 15 times the real part of the asset. 2 over 15 times the real part of the asset. 1 over 15 times the real part of the asset. What you have will now be the depreciation for the period. But where you don't have residual value, use costs. Is that clear? Now, under this one, we also have what we call asset register. What do we mean by asset register? Under the asset register is a statement that gives the details of the company's what? All the company's what? Asset. It summarizes all the company's assets in a simple format. What are the contents or the information that are under what? On the asset register? We have the what we call serial number, the asset name, asset classification, we have what we call asset useful life, we have the depreciation method, annual depreciation, accumulated depreciation. We also have what we call residual value or scrap value or salvage value of the depreciation. All these are what you are meant to have when it comes to what asset register. All companies are meant to what look into this. Then the next one is what we call as non-current asset schedule. Non-current asset schedule. Non-current asset schedule. Non-current asset schedule is a statement prepared to know the state of the asset on a periodic basis. Now under this, we have this is how it look like. We have the opening balance of the asset, which can be in terms of cost. We have the addition, we have the reclassification, we have the disposal, asset disposal, we have the valuation, then we have the closing balance for each of the assets. Property, plant, equipment, you totaled everything, you have your total here. Then the depreciation, you have your depreciation rate, you have the opening balance of the accumulated depreciation, we have reclassification, we have disposal, we have revaluation, we have what we call current charge, then we have the closing balance. This is what we refer to as, then we have what we call net book value or carrying amount for the beginning of the year. That is for the first year. That's your current year. Why the previous year is going to be this. How do we calculate it? When we get to where we are going, we'll do the calculation. Then we can be on the same page. Please, any question, please?
Have I not checked? I did yourself, please.
Any question? Okay. Now we have what we call asset revaluation. This is a process of determining the new amount of an asset by using upward or downward revaluation model. When it comes to upward revaluation model, this situation is where the revalued amount is higher than the opening balance or the book balance. The difference between the book balance or the opening balance and the revalued amount is called revaluation what? Surplus or deficit. Revaluation surplus or deficit. Now, when it is surplus, what is the accounting treatment? Look at it here. You debit the asset account and credit what? The statement of financial performance, that is income and expenditure statement. We now say note, where there is accumulated depreciation on asset revalue, you are to net off all the accumulated depreciation from the revaluation surplus. Then the remaining balance will be taken into the asset account. The balance of the surplus will be taken to asset account. Any question, please? Now, when it comes to downward revaluation, this is another situation whereby the residual value is lesser than the book value of the asset or the opening balance. The residual value, that is revaluation value amount, is known as your closing balance. The difference is called what? Revaluation deficit. What is the accounting treatment? Look at it. Debit the statement of income, statement of what? Financial performance, which is your income statement account, and credit the asset account with the residual, with what? Revaluation deficit. That is the treatment for that. Then the next one is what we refer to as what? Asset disposal. This is a situation whereby an entity owned asset is offered for sales after the economic useful life or usage. What is the accounting treatment? One, debit the asset disposal account with the cost of the asset disposed, credit the asset account with the cost of the asset disposed. The second one, number two, debit the depreciation account with accumulated depreciation of the asset disposed, credit the disposal account with the accumulated depreciation of the asset disposed. The next one, debit the bank account or cash account with the proceeds received on the asset disposed. Credit the asset disposal account with the proceeds received on the asset disposed. This is the accounting treatment for that. And looking at it from here, statement of property plant. Look at it, sorry. Statement of profit or loss on disposal. When you want to determine the profit or loss on disposal, we have what we call proceed on disposal. We have what? Net book value or carrying amount. Cost, now less what? Accumulated depreciation. What you have is what we call net book value. Net book value. You now less that net book value from the proceed to determine the profit or loss on disposal. Any question? Any question, please? Any question, please?
No, sir.
Now, I will forward this note to you also for you to go through it on your own. Now, let's now look at question one after the other. We're meant to look at question on IPSAS 2. We're meant to look at question on IPSAS 17. We're meant to look at question on IPSAS 13 and IPSAS 33. Those are the calculation parts that we need to have idea of how to treat those items one after the other. Are we together? Now, let's look at the last note that we have under this part. Is a practical question from ICAN we want to look at now. Practical question from ICAN. This question came out in what year? What diet? That was during the COVID time, when we have March and July 2020. That was the COVID time. Look at the question. Do you have idea of what the question is all about? Hello?
Hello, sir.
Do you have idea of the question? Compulsory question, 40 marks. Question number 1. In the year 2000, Amotekun State of Nigeria established 2 universities, namely Amotekun University, ASU, and Amotekun University of Education, ASU, to cater for the indigene of the state. The following information relates to each of the university. A. The bursar of Amotekun State University, Okemoson, delegated the preparation of non-current asset schedule to be included in the financial account, in the final account of the university for the year ended 31st December 2008. So one of the deputy bursar in the bursary department, in discharging of the assignment, the deputy bursar reviewed the following documents. 1. International Public Sector Accounting Standard, previous year financial report, non-current asset register, valuation report. He was able to obtain the following information. 1. Cost/fair value as at 31st December 2017. This is the cost and the fair value of the asset. Accumulated division is also given to us, and estimated lifespan/lease period of the asset were given to us in details. We now move on. It is the policy of the university to charge full year depreciation on assets irrespective of the month of purchase or revaluation during the year, while no depreciation is charged on the asset disposed of during the year. The next one, number 2. Equipment on lease are depreciated equally over the period of the lease. Land and building were professionally revalued during the year by Parisco and Associates, a firm of chartered surveyor and valuers, and approved by the State Ministry of Works and Housing. This The valuation, which was based on open market value, produced a revaluation surplus of 150,000 over the carrying amount as at January 1st, 2018. Number 6. The university acquired plant and machinery which was imported from United Kingdom at a cost 430,500. In the installation cost and transportation to the university amounted to 20,500,000. The next one, deputy bursar that prepared the non-current assets last year classified some of the computer equipment purchased on 1st of May 2017, costing this as office equipment, and reclassification is required in the current year. We also have it here as office furniture and fittings cost 12,250,000 were disposed of during the year for 11,500,000, which resulted to a profit of 750,000. The next one, university enter into an equipment lease agreement on Ode Finance Limited. The terms and conditions for the finance lease are as follows. Principal sum 45 million. Lease period 5 years. Lease renter 10 million per annum. During the year, university acquired a fleet of vehicles at cost of 50 million. The state government financed this acquisition required. In accordance with IPSAS 13, identify 5 features of finance lease. We've treated this one. What are the features of finance lease? The lease payment is meant to be capitalized. Possibility of transferring the ownership at the end of the lease, at the end of finance lease contract is possible. Then the benefit is attributable to lessor. The benefit of the property is attributable to lessee. Sorry, the risk of that particular property is also attributable to lessee because it's meant to maintain that particular property. All these are the words in this. They now said prepared non-current asset schedule of Amotekun University suitable for publication. What will you do? 15 marks. How will you go from there? That is A part of the question. The second one is the B part of the question. Which is later. That one is also on what? Cash flow. This one, look at it. Now, B part of the question here says what? You should prepare what? Cash flow statement for 2018 using direct method. But in this question, in line with what IPSAS 2, I will use the 2 method for you to help you, for you to have idea of how to go by what? The 2 method. Any question? Hello? We are tired. Hello?
Hello, sir.
We are tired with the question. It's too much.
It's
Abi?
too much, so yes, sir.
That's ICAN for you now.
Right.
How do we go from here? Eh? Now, we cannot finish all the questions today, but let's go and solve the A part of the question. We'll come back next week to solve the cash flow. Is that clear? Is that clear?
All right, sir.
Yes, sir.
Do you want a prepared solution or you want me to prepare it now?
Prepare it now, sir.
Yes.
I should prepare it now, Abi?
Yes, sir.
Okay. Yeah, let's go.
Yes.
Yes.
Now, this is a question on what? I will indicate. This is solution on IPSAS 17. What's the name of the organization? Amotekun State University. What do they say we should prepare? Non-current asset schedule. For the year ended 31st December 2018. We have the assets, Abi. Now, what are the assets of the company? Can you give me? What are the assets given to you?
Land and building.
Land and building. What else again?
Furniture and fittings.
Furniture and fitting.
Office equipment.
Aside office equipment, what do we also have?
Plant and machinery.
Plant and machinery. What else again?
Motor vehicle.
What else again?
Computer equipment.
What else again?
Equipment on lease.
That what else again?
That's just
Then we now put the total here.
yes.
Do they abbreviate that in thousand?
It's in thousands, sir.
Okay. We also do the abbreviation in thousand. Now, if you look at the format given to you, how do we go from there? First thing you have is opening balance. You put it here. Opening balance. After the opening balance, you have addition. Is that not so? Hello?
Yes, sir.
After the addition, we have reclassification. After the reclassification, what do we also have? Disposal. After disposal, what do we also have? Revaluation. Revaluation. What type of revaluation do you have there? We specify as we are moving. Then after that, we have closing what? Then the next one is what? Depreciation. Slash rate, depreciation rate. We have opening balance of depreciation. We have reclassification. We have reclassification, we have depreciation, we have revaluation. Then here, we have what we call current charge. Then you have closing balance. Can you see the way it look like? Hello?
Yes, yes, sir.
Not to be confused. Hmm. Now let's go to the question. What can you give me the opening balance of all those assets, one after the other? And the depreciation, one after the other.
Land and building, 500.
Land and building, 500,000. Come in, please. Please hold on a bit, please. There is something I didn't give to you that I need to add today. Now, after this, you now have what we call net book value slash carrying amount. This one will be for 31st 12 2018. This will be for 2017. Immediately you are done with all this, that's the end. Now, let's continue with the assets now. You said this one is 500,000, Abi?
Yes, sir.
What else again? For furniture and fitting, what is opening balance for furniture and fitting?
180,000.
180,000. The next one,
130,000. Office equipment.
130,000. The next one,
190,000. Plants and machinery.
190. The next one,
Motor vehicle. 500,000.
the next one,
Computer equipment. 160,000. 160,000.
equipment on lease,
105,000.
then the total. Now, let's now start going through the notes one after the other. Now, before going through the notes, what are the accumulated depreciation given to you? Accumulated depreciation on those assets. Accumulated depreciation you are given is in the question. After the cost and the fair value given to you, the next one is accumulated before giving you the carrying amount.
50,000.
For the first one, 50,000.
Yes.
72,000.
65,000.
How much?
65,000.
65,000.
95,000.
95,000.
200,000.
200,000.
80,000.
80,000.
42,000.
42,000. Then you add everything together to know the balance of your accumulated depreciation. This is it here. Now, you are now meant to look at the notes one after the other.